Beloved seekers of wisdom, dear family of patient builders and disciplined thinkers, there is a number that haunts the dreams of every investor, a percentage that represents not just wealth but freedom, not just returns but transformation, 30% annually. It sounds impossible. It sounds like fantasy. It sounds like the promise of charlatans and dreamers. T. Dangros Duram, but what if I told you that this number is not fantasy, that it's been achieved, repeatedly, by people who understood something that most investors never learn, by people who were willing to do what most investors refuse to do, by people who had the patience to wait and the courage to act when others were paralyzed by fear. 30% annual returns, compounded over time. Do you understand what this means? Let me show you the mathematics of transformation. $100,000 growing at 30% annually becomes $130,000 in year 1, $169,000 in year 2, $220,000 in year 3, and then the curve begins to bend. By year 5, you have $371,000. By year 10, $1.3 million. By year 15, $5 million. By year 20, $19 million. From $100,000 to $19 million in 20 years. That's not wealth. That's generational transformation. That's the difference between working until you die and having your great-grandchildren financially secure. But here's what you need to understand before we go any further. Here's the truth that most people don't want to hear. Here's the reality that separates those who achieve extraordinary returns from those who merely dream about them. 30% annual returns are possible, but they're not easy. They're not consistent. They're not achievable through passive index investing. They require something more, something deeper. Something that most investors lack the patience, the discipline, the emotional fortitude to execute. And attempting to achieve them without understanding what you're doing, that's not investing. That's gambling. And gambling destroys more wealth than it creates. So before I give you the framework, before I share the strategies that have produced these returns throughout history, I need to tell you why most people fail. Why most people who chase high returns end up with nothing. Why the dream of 30% becomes the nightmare of losing everything. Let me tell you about a man I knew. We'll call him Richard. Brilliant man. Engineer by training. Analytical. Disciplined in every area of his life except one. Richard heard about an investor who was generating 40% annual returns. Consistent returns. Year after year. And Richard became obsessed. He thought, if someone else can do it, why can't I? So he started trading aggressively. He'd read everything he could about options, about leverage, about technical analysis, about momentum trading. He believed he could outsmart the market. Believed he could find patterns others missed. Believed his intelligence would translate into investment success. In his first year, he made 63%. 63%! He was euphoric. He felt like a genius. He'd discovered the secret. He told everyone who would listen about his success. He quit his job to trade full-time. Year 2, he made 18%. Still good, still beating the market. Still confident in his approach. Year 3, he lost 42%. 42% gone. In a single year, market conditions changed. His strategies stopped working. Volatility spiked, and suddenly his brilliance became his downfall. He tried to make it back, took bigger risks, used more leverage, chased more aggressive trades, and he lost another 35% in year 4. After 4 years of trying to achieve spectacular returns, he had less money than when he started. Not just a little less, 40% less. And he'd spent 4 years of his life consumed by stress, obsession, and ultimately failure. Richard's story is not unique. It's the story of countless investors who chase high returns without understanding what they're chasing. Who mistake luck for skill? Who confuse a bull market for genius? Who lack the psychological discipline that exceptional investing requires? So let me be clear, crystal clear. If you're looking for a get-rich quick scheme, if you want some magical formula that requires no effort, no understanding, no discipline, stop watching now. This is not that. But if you're willing to understand the principles, if you're willing to develop the skills, if you're willing to have the patience that extraordinary investing requires, then what I'm about to share could change your life. Because 30% annual returns are achievable. They've been achieved, repeatedly, throughout history. by investors who understood certain principles and had the discipline to execute them. The greatest investor of our time achieved 20% annually for 6 decades. 6 decades. That's not luck. That's not market timing. That's understanding what creates value and having the patience to let that understanding compound. Another legendary investor achieved 29% annually over 20 years. Another achieved 32% over 13 years before returning outside capital. These are real people, real returns, documented, verified, achieved through approaches that can be studied and learned. But here's what they all had in common. Here's what separates them from the Richards of the world who flame out spectacularly. They weren't chasing returns. They were finding value. They weren't trading frequently. They were investing for years. They weren't using leverage recklessly. They were buying wonderful businesses at fair prices and letting compound interest work its magic. They achieved spectacular returns not by trying to achieve spectacular returns, but by focusing on the process, on understanding businesses, on buying at the right price, on being patient, on thinking independently, on having the courage to be different. And that's the paradox. The secret to achieving extraordinary returns is not focusing on the returns. It's focusing on the process, the mindset, the discipline, the patience. Returns are the outcome. They're the result of doing everything else right. They're what happens when you combine deep understanding with emotional discipline, with perfect patience, with opportunistic timing. So let me give you the framework, the principles that have generated extraordinary returns throughout history. Not guarantees. There are no guarantees in investing, but principles, approaches, mindsets that tilt probability dramatically in your favor. Principle 1, know the difference between price and value. This sounds simple. It's not. Most investors think they're the same thing. They look at a stock price and assume it reflects what the business is worth. They see a price going up and assume the value is increasing. They see a price going down and assume the value is decreasing. But price and value are different. Price is what you pay. Value is what you get. And the gap between the two, that gap is where extraordinary returns come from. Every business has an intrinsic value, a value based on the cash flows it will generate over its lifetime, a value based on its competitive advantages, its management quality, its growth prospects, its return on capital. That intrinsic value doesn't change much from day to day, or month to month, or even year to year for stable businesses. It grows slowly as the business compounds earnings and reinvests in growth, but price fluctuates wildly, every day, based on emotions, based on news flow, based on momentum, based on fears and hopes that have nothing to do with the underlying business value. Most investors focus on price. They buy what's going up. They sell what's going down. They follow momentum. They react to news. And they achieve mediocre returns or worse. Extraordinary investors focus on value. They estimate what a business is truly worth. And then they wait patiently, sometimes for years, for price to diverge significantly from value. When a wonderful business trades at 50 cents on the dollar, they buy, aggressively, with conviction. Not because the price is going up, but because the gap between price and value is enormous. And then they wait. They wait for the market to eventually recognize what they recognized earlier. They wait for price to rise to meet value. And when it does, when that gap closes, they've achieved extraordinary returns. Not through genius, but through patience and discipline and the ability to estimate value accurately. This is how you achieve 30% returns. Not every year, not consistently, but over time through multiple cycles, by repeatedly finding situations where price has diverged dramatically from value. Let me tell you about one such situation. In late 2008, during the financial crisis, the entire market collapsed. Everything went on sale. Wonderful businesses trading at prices not seen in decades. There was a particular company, insurance company, rock solid balance sheet, excellent management, trading at 60% of book value, meaning the market was valuing the business at less than the value of its assets, as if the business itself had negative value, as if it would never generate another dollar of profit. Anyone who understood insurance, who understood this company, who understood value knew this was absurd. This company would survive, would thrive, would compound book value at high rates for years to come. But the market didn't care. The market was panicking. Margin calls were forcing selling. Fear was overwhelming analysis. and the price kept dropping, I bought heavily, not because I knew the price would go up tomorrow, but because I knew the value was far higher than the price. And I knew that eventually, inevitably, price would rise to meet value. Over the next 5 years, that investment returned over 250%, 50% annually, not through trading, not through timing, but through buying a wonderful business at an absurd price and having the patience to wait for the market to correct its mistake. That's principle 1. Understand value. Wait for price to diverge dramatically from value. Buy when that happens, and wait for the gap to close. Principle 2. Concentrate your bets. This goes against everything modern portfolio theory teaches, against everything financial advisors tell you, against conventional wisdom about diversification, but it's essential for extraordinary returns. You cannot achieve 30% annually by owning 200 stocks, by buying index funds, by being diversified across every sector and geography. Diversification is protection against ignorance. If you don't know what you're doing, if you can't identify value, if you can't analyze businesses, then yes, diversify broadly. Own everything, accept market returns. But if you can identify value, if you can find wonderful businesses at great prices, then concentration creates wealth, putting large amounts of capital into your best ideas, your highest conviction positions, the opportunities where the gap between price and value is largest. The greatest investors concentrate. They own 10, 20, maybe 30 positions, not hundreds. They put 30, 40, 50% of their portfolio in their single best idea. They're not trying to own a little of everything. They're trying to own a lot of the best things. This requires confidence, knowledge, the ability to withstand volatility, because concentrated portfolios are volatile. They move more dramatically than diversified ones. They can be down 30% one year and up 70% the next. Most investors can't handle this. The volatility terrifies them. They see their concentrated position drop 20% and they panic. They sell. They abandon the strategy right before it works. But extraordinary investors understand that volatility is the price of extraordinary returns. That concentration means bigger swings. That you must be comfortable being uncomfortable. That temporary declines don't matter if you bought at the right price. This is not recklessness. This is calculated risk. This is knowing what you own, why you own it, what it's worth, and having the conviction to hold through volatility because you absolutely know, that you bought at a price significantly below value. Principle 3. Think in decades, not quarters. This might be the hardest principle for most people to embrace, because we live in a world of instant gratification, of quarterly earnings reports, of daily stock prices, of constant news flow telling us to react, to adjust, to do something. But extraordinary returns don't come from constant activity. They come from finding the right opportunities and then doing nothing for years, sometimes decades. Let me tell you about a position I held for 18 years. 18 years. I bought shares in a newspaper company in 1985. Local monopoly, excellent economics, strong cash flow, trading at a reasonable price. And I did nothing. I didn't trade in and out. I didn't try to time the market. I didn't sell when it dropped. I didn't sell when it rallied. I just held for 18 years. During that time, the stock price fluctuated wildly. Some years up 40%, some years down 20%. But the business kept compounding, kept generating cash, kept buying back shares, kept increasing its intrinsic value. When I finally sold in 2003, that investment had returned over 28% annually. Not through trading genius, not through market timing, but through buying a good business at a fair price and letting time do the heavy lifting. This is what most investors cannot do. They cannot sit still. They cannot resist the temptation to act. They see their stock drop 15% and they think they need to do something. They see another stock rallying and they think they're missing out. They read about a new opportunity and they want to chase it. But activity is the enemy of returns. Every trade has costs, transaction costs, tax costs, and most importantly, the cost of being wrong, because most trades are wrong. Most decisions to sell a good business are mistakes. Most attempts to time markets fail. The extraordinary investors understand this. They make very few decisions, but the decisions they make are high quality, deeply researched, high conviction. And then they let those decisions play out over years. This requires a different psychology than most people possess. It requires the ability to ignore noise, to resist comparison, to trust your analysis even when the market disagrees, to do nothing when everyone else is doing something. But this psychology, this ability to be patient, is more valuable than any analytical skill, because even mediocre analysis combined with extraordinary patience produces good results. But brilliant analysis combined with impatience produces mediocrity. Principle 4: buy when others are fearful. You've heard this before. Everyone has. It's become a cliché. But like many clichés, it's true. And like many truths, it's far harder to execute than to understand. The times of maximum opportunity in markets are the times of maximum fear. 2008, 2001, 2002. These were years of extraordinary returns for those who had the courage to buy when everyone else was selling. But courage is the operative word, because buying during crashes, it doesn't feel like opportunity. It feels like catching a falling knife. It feels like you're about to lose everything. It feels stupid. The news is apocalyptic. Experts are predicting disaster. Prices are plummeting. Everyone you know is selling. Every instinct you have is screaming at you to get out, to preserve what you have left, to wait for certainty. And that's exactly when you should be buying. Not recklessly. Not without analysis. But systematically, aggressively, with the conviction that comes from understanding that fear creates opportunity. Let me tell you about March 2020. The COVID crash. The market dropped 35% in a month. Fastest crash in history. Panic everywhere. Businesses shutting down. Unemployment spiking. Nobody knew what would happen. I had been holding significant cash, waiting, patient. Markets had been expensive for years. I'd been criticized for holding too much cash, for missing the rally, for being too conservative. But when March 2020 came, I deployed aggressively, bought wonderful businesses at prices I hadn't seen in a decade, airlines at 70% discounts, banks at 60% discounts, quality companies across every sector suddenly on sale. And I didn't try to buy the bottom. I didn't wait for certainty. I bought into the fear, scaled in as prices fell, accepted that I might be early, understood that I was trading temporary discomfort for long-term opportunity. Those positions, many of them doubled or tripled within a year. Some of them generated 50, 70, 100% returns in 12 months. Was that skill? Partly. I recognized that the crash was driven by fear, not by fundamental deterioration in business values. I understood that COVID, while serious, wasn't going to permanently destroy quality businesses. But mostly it was preparation. It was having cash available. It was having the psychological readiness to act when others were paralyzed. It was years of studying market history and understanding that crashes create the best buying opportunities. This is how you achieve extraordinary returns, not by trying to make money every year, not by being fully invested all the time, but by being patient, holding cash when necessary, and then being aggressive when opportunities arise. Principle 5: understand the businesses you own. This sounds obvious. It's not. Most investors own things they don't understand. They buy stocks based on tips, based on momentum, based on what's hot, without ever understanding what the business actually does, how it makes money, what its competitive advantages are, why it will succeed or fail. And this is fatal to achieving extraordinary returns, because if you don't understand what you own, you'll sell at the wrong time. You'll panic when the stock drops. You'll sell when you should be buying more. You'll miss the compounding that creates wealth. Extraordinary investors only buy what they understand, deeply understand. They can explain the business model to a child. They know the key metrics that drive success. They understand the competitive landscape. They've read every annual report. They know management personally if possible. They understand why this business will be worth more in 10 years than it is today. This understanding, this deep knowledge, gives them the confidence to hold through volatility, to buy more when prices drop, to ignore noise and focus on fundamentals, to think like an owner, not a trader. Let me tell you about a mistake I made. Early in my investing career, I bought shares in a technology company. Hot sector. Stock was rising. Everyone was talking about it. I bought without really understanding what the company did, how it made money, what its competitive position was. The stock kept rising for a while. I felt smart. Then it dropped 20%, then 30, then 50, and I had no idea what to do. I didn't know if this was a buying opportunity or a disaster. I didn't understand the business well enough to make an informed decision. I panicked, sold near the bottom, locked in massive losses, and then watched the stock recover over the next 2 years and go on to triple from where I sold. That experience taught me a lesson worth more than the money I lost. Never buy what you don't understand, no matter how hot it is, no matter how much it's rallied, no matter who's recommending it. If you can't explain why it will create value over the next decade, don't buy it. Since then, I've only invested in businesses I understand thoroughly. Sometimes this means missing opportunities, technologies I don't understand, industries outside my circle of competence, trends I can't evaluate. And yes, some of those have gone on to generate spectacular returns. But I've also avoided disasters, frauds I would have fallen for if I'd been chasing returns without understanding, bubbles I would have participated in if I'd been following momentum, businesses that looked good on the surface but had fatal flaws I would have missed without deep analysis. And the investments I have made, the ones I understood deeply, those have produced the returns that matter. Not every one, but enough of them, with enough conviction that I could size them appropriately, with enough understanding that I could hold through volatility. This is principle 5. Understand what you own. Only buy businesses you can explain. Know why they'll create value, and that understanding will give you the confidence to execute the other principles. Principle 6, wait for the fat pitch. This is a baseball analogy, but it applies perfectly to investing. In baseball, you have to swing at pitches in the strike zone. You get 3 strikes and you're out. You're forced to be active. But in investing, there are no called strikes. You can watch pitch after pitch go by. You can wait months, years for the perfect opportunity. And when it finally comes, when you see a pitch right in your sweet spot, you can swing hard. Most investors don't operate this way. They feel like they have to be active. They see opportunities everywhere. They swing at everything. They buy constantly, convinced that doing something is better than doing nothing. But extraordinary returns come from patience, from waiting, from watching thousands of potential investments and passing on almost all of them, from having the discipline to say no, 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 and then yes, emphatically yes, when the truly exceptional opportunity arrives. I've gone years without making a significant new investment, years of just holding existing positions, years of accumulating cash, years of researching businesses but not finding anything compelling at reasonable prices. And then a crash comes, or a specific business faces temporary problems that drive the stock price down dramatically, or an entire sector falls out of favor. And suddenly there are 10, 15, 20 opportunities that meet my criteria. And that's when I act, aggressively, deploying large amounts of capital rapidly, making in a few months the investment decisions I couldn't make in the previous few years. This lumpy pattern, long periods of inactivity, followed by bursts of intense activity. This is how extraordinary investors operate. They're not trying to be busy. They're trying to be effective. They're not trying to make money every day. They're trying to make a lot of money when the opportunities are exceptional. But this requires psychological strength. It requires resisting the urge to act, resisting the comparison to others who seem to be making money while you're sitting on cash, resisting the feeling that you're missing out, resisting the pressure to justify your existence through constant activity. The investors who can do this, who can wait patiently for their pitch, they're the ones who achieve extraordinary returns, not through constant brilliance, but through occasional brilliance combined with relentless patience. Now let me talk about something critical, something that will determine whether you succeed or fail in pursuing high returns. Risk management. The pursuit of 30% annual returns involves risk, significant risk. There's no way around this. Higher returns require higher risk. Anyone who tells you otherwise is lying. But risk management is not about avoiding risk. It's about taking calculated risks, about understanding what you're risking, about ensuring that when you're wrong, and you will be wrong sometimes, you don't get wiped out. The mathematics of loss are brutal. If you lose 50%, you need to make 100% just to get back to even. If you lose 75%, you need to make 300% to recover. These are nearly impossible to achieve. So the key to achieving high returns sustainably is never losing so much that recovery becomes impossible, never taking risks that could destroy you, never being so concentrated, so leveraged, so exposed that a single mistake ends your investing career. This means several things practically. First, never use leverage recklessly. Leverage amplifies gains, but it also amplifies losses. And worse, it creates forced selling at the worst times. When you're leveraged and markets drop, you get margin calls. You're forced to sell at depressed prices. You lock in losses that unleveraged investors can ride out. Some of the greatest investors use no leverage ever. They invest only their own capital. They accept that this limits their maximum returns, but it also ensures their survival. And survival is the first rule of investing. Second, never bet everything on a single position, no matter how confident you are. Yes, I said concentrate. Yes, extraordinary investors put large percentages in their best ideas. But there's a difference between concentration and recklessness. Even your best analysis can be wrong. Even wonderful businesses can face unexpected problems. Even the most careful research can miss something. So never structure your portfolio such that being wrong once destroys you. A good rule: no single position should be more than 5 to 35% of your portfolio, no matter how confident you are. This leaves room for being wrong, room for recovery, room for other opportunities. Third, understand the difference between temporary impairment and permanent loss of capital. When you buy a stock and it drops 20%, that's not necessarily a loss. If the business value hasn't changed, if your analysis was correct, that's an opportunity to buy more at better prices. Permanent loss occurs when the business itself is impaired, when competitive advantages erode, when management destroys value. When your analysis was fundamentally wrong about the business quality, this distinction matters enormously. Temporary price fluctuations are irrelevant if you bought at the right price, and the business continues creating value. But permanent impairment means you were wrong, means you need to sell and accept the loss. The key is knowing which is which, and that comes back to understanding what you own. If you know the business deeply, you can distinguish between temporary market volatility and fundamental deterioration. If you don't, you'll make mistakes in both directions. Tieci compiunde iracle. Now we arrive at the heart of everything, the secret that ties all these principles together, the force that transforms good returns into extraordinary wealth, the miracle that makes 30% annually not just a number, but a pathway to generational transformation. Compounding, true compounding, not just investment returns compounding, but knowledge compounding, skill compounding, judgment compounding, discipline compounding. Most people think about compound interest purely mathematically. Money growing on money. Returns generating more returns. And yes, that's part of it. That's the mechanical part. But there's something deeper. Something that separates those who achieve extraordinary returns consistently from those who get lucky once and then regress to the mean. The best investors get better over time. Their knowledge deepens. Their judgment sharpens. Their ability to identify value improves. Their psychological discipline strengthens. They compound not just capital, but capability. Let me tell you about my own journey. When I started investing seriously in my 30s, I made mistakes constantly. I bought businesses I didn't understand. I sold too early. I held losers too long. I let emotions drive decisions. I chased trends. I was impatient. My returns in those early years were mediocre, sometimes good, sometimes terrible, highly inconsistent. I was learning, painfully, expensively, but learning. But I kept at it. I read everything I could. I studied the great investors. I analyzed my mistakes ruthlessly. I developed frameworks. I built checklists. I worked on my psychology. I learned to recognize my own biases and tendencies. And slowly, gradually, my results improved, not linearly. But over time, the average got better. The consistency improved. The mistakes became less frequent and less costly. The winners became bigger. The losers became smaller. By my 50s, I was a completely different investor than I'd been in my 30s. Not because I was smarter, intelligence doesn't change much, but because I had decades of experience, decades of pattern recognition, decades of seeing cycles repeat, decades of making mistakes and learning from them, and that accumulated knowledge, that compound expertise, that's what enabled sustained high returns. Not through some secret formula, but through deeply internalized wisdom about what works and what doesn't. This is the compounding that matters most. This is what creates investors capable of consistently finding opportunities that generate extraordinary returns. Not luck, not genius, but accumulated wisdom applied with discipline. And here's the beautiful part. This compounding of knowledge is available to everyone. You don't need to be brilliant. You don't need special access. You don't need to start with millions. You just need to commit to the process, to learning, to improving, to getting 1% better every year. That 1% improvement, compounded over 20, 30, 40 years, transforms you into an investor capable of identifying opportunities others miss, of having the courage to act when others are paralyzed, of generating returns others think impossible. But this requires something rare in our modern world: patience. Not just patience with investments, but patience with yourself, patience with the learning process, patience with the inevitable mistakes and setbacks. Most people quit too early. They try investing for a few years. They make mistakes. They lose money, and they conclude they're not good at it. They give up. They go back to passive index funds or delegate to advisors. But the great investors pushed through that phase. They accepted that mistakes were part of learning. They treated losses as tuition. They studied what went wrong. They adjusted their approach. They kept going. And after years, decades, they emerged as truly skilled investors. Not because they were born with some special talent, but because they stayed in the game long enough to develop the pattern recognition, the judgment, the discipline that exceptional investing requires. Now let me address something crucial. Something that will determine whether you can actually execute what I'm teaching you: the psychological dimension, the emotional control, the mental discipline. You can know every principle I've shared. You can understand value investing perfectly. You can identify wonderful businesses at great prices and still fail completely if you lack psychological discipline. Because knowing what to do and actually doing it, those are completely different things, especially when markets are crashing. When your positions are down 40%, when everyone is selling, when the news is apocalyptic, when every fiber of your being is screaming at you to get out, that's when discipline matters. That's when you discover whether you actually have the temperament for extraordinary investing. That's when most people fail. I've seen brilliant analysts, people who could value businesses better than anyone, fail as investors because they couldn't control their emotions. They do perfect research, identify perfect opportunities, buy at perfect prices, and then panic when the stock dropped 20%, sell at the worst time, lock in losses, miss the recovery. The problem wasn't their analysis. It was their psychology. They couldn't handle the discomfort, couldn't tolerate looking stupid temporarily, couldn't trust their own work when the market disagreed. This psychological discipline, this emotional control, it's not something you're born with. It's something you develop through experience, through practice, through consciously working on it. Here's what I learned works. First, never invest money you need in the short term. If you might need access to capital in the next 3 to 5 years, don't invest it in stocks. Keep it safe. Keep it liquid, because knowing you might need to sell at forced times destroys your ability to make good long-term decisions. Second, size positions appropriately for your psychological comfort. Yes, concentration is important. But if a position is so large that you can't sleep at night, if you're checking the price constantly, if you're stressed and anxious, it's too big. Scale it back. You can't make good decisions from a place of panic. Third, develop a process and trust it. Write down your investment thesis when you buy. What you think the business is worth. Why you're buying. What would make you sell. And then when the stock drops and you're tempted to sell, go back and read what you wrote. Has anything fundamental changed? Or is this just market noise? Most of the time it's just noise. The business hasn't changed. Your analysis was sound. The price drop is temporary. And reading your original thesis reminds you why you bought, gives you the confidence to hold or even buy more. Fourth, study market history. Read about past crashes. Understand that every crash feels like the end of the world when you're in it. But every crash has eventually resolved. Every panic has eventually passed. Every market bottom has eventually led to new highs. This historical perspective, this understanding that this too shall pass, it's invaluable during difficult times. It prevents you from making permanent decisions based on temporary conditions. Fifth, accept that you will be wrong sometimes. Even the best investors have losing positions. Even the most careful analysis misses things. Even wonderful businesses face unexpected problems. Accept this. Embrace it. Plan for it. The goal is not perfection. The goal is being right more often than wrong. Having your winners be bigger than your losers. Cutting losses when you realize you were wrong. Letting winners run when you were right. This produces extraordinary returns over time, even though many individual positions disappoint. Now let me talk about something that makes achieving 30% returns even more powerful. Time horizon. The longer your time horizon, the more certain your success becomes. The shorter your time horizon, the more you're gambling. If you need 30% this year, if your entire plan depends on hitting that number in the next 12 months, you're going to take excessive risks. You're going to chase, you're going to use leverage, and you're probably going to fail. But if you're thinking in decades, if you understand that 30% averaged over 20 years includes some years at 5% and some years at 60%, if you're patient enough to let opportunities come to you, then success becomes probable rather than possible. The great investors think in decades. They buy businesses they're comfortable owning for 20 years. They're not trying to make money next quarter. They're trying to make a fortune over their investing lifetime. This long-term orientation changes everything. It eliminates the pressure to perform constantly. It allows you to wait for truly exceptional opportunities. It lets you ignore short-term noise. It enables you to structure your life and your psychology for patient capital deployment rather than constant trading. And paradoxically, this patient approach often produces better short-term results than trying to maximize short-term results. Because you're not forcing anything. You're not taking marginal opportunities. You're only swinging at fat pitches. And those fat pitches, even in the short term, tend to work out well. Let me share with you a framework for actually implementing what I've taught you. A practical approach you can start using immediately. Step 1, build your knowledge. Before you invest $1 beyond index funds, spend time learning. Read the classics. Graham's Intelligent Investor, my essays and annual letters, Buffett's letters, Fisher's Common Stocks and Uncommon Profits. Read annual reports of businesses you admire. Study market history. Understand cycles. This education phase might take months or years. That's fine. That's appropriate. You're building a foundation that will serve you for decades. Don't rush it. The market will be there when you're ready. Step 2, start small and focused. Don't try to build a portfolio of 50 stocks. Start with 1 or 2 businesses you understand deeply. Invest modest amounts. Amounts where being wrong won't destroy you, but being right will teach you valuable lessons. Watch how those businesses perform, how their stocks move, how you feel when they drop, how you react to volatility. This is education, too. You're learning about yourself as much as about investing. Step 3, develop a research process. Create checklists. What do you look for in a business? How do you value it? What signals buy or sell? Don't rely on gut feel. Don't wing it. Have a systematic approach that you follow consistently. This process will evolve over time. That's good. You're learning what works for you. What questions matter most, what red flags you should never ignore. But having a process, even an imperfect one, is better than random decisions. Step 4, be patient with opportunities. Don't feel pressured to be fully invested. Hold cash until you find truly compelling opportunities. Opportunities where your research suggests the business is worth significantly more than the price. Where you have real conviction. This might mean going months or years between major investments. That's fine. That's actually good. It means you're being selective, waiting for your pitch, not forcing anything. Step 5, when you find truly exceptional opportunities, act with conviction. This is where concentration comes in. When you've done the work, when you understand the business deeply, when the price is clearly below value, when you have real conviction, invest meaningfully. Not your entire portfolio, but enough that being right matters, enough that the position can actually move your wealth. Step 6, after buying, do nothing unless something fundamental changes. Don't check prices daily. Don't react to news. Don't second-guess yourself. You did the work. You bought at the right price. Now let time do its job. Review your positions quarterly or annually. Has the business thesis changed? Is management executing? Are competitive advantages intact? If yes, hold. If no, sell and move on. But don't let price movements alone drive decisions. This framework, executed with discipline over years, can produce extraordinary results. Not through magic, not through genius, but through systematic application of proven principles. Now I want to address one final topic, one that many people struggle with. The question of when you've achieved enough. When the pursuit of returns can slow down. When you can shift from aggressive wealth building to wealth preservation. Because here's a truth many driven investors never learn. The goal is not to die with the most money. The goal is to live well. To have enough that you're free from financial stress. To have enough that you can be generous. To have enough that your family is secure. To have enough that you can pursue meaning rather than just accumulation. There comes a point, a different point for everyone, where additional wealth doesn't improve your life, where the time and energy spent pursuing 30% returns could be better spent living, with family, with purposes beyond money, with experiences that compound in ways money never can. The great tragedy I've seen is investors who never reach this point, who accumulate tens of millions but can never stop, who are wealthy beyond any reasonable need but still obsessed with making more, who sacrifice relationships, health, peace of mind for portfolio growth they don't need. Don't make this mistake. Pursue extraordinary returns when you need them, when you're building wealth, when financial freedom is still a goal rather than a reality. But once you've achieved enough, once you have true security, consider whether continuing the pursuit serves you or enslaves you. There's no shame in shifting to simpler strategies once you've won, in owning index funds and spending your time on other pursuits, in accepting market returns rather than chasing exceptional ones, in choosing peace over performance. This wisdom, knowing when enough is enough, it's perhaps the most important financial lesson of all. Because money is a tool, a means to an end. And if you never define the end, if you just accumulate forever without purpose, you've missed the whole point.